Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market Site, we have Borsai, co-founder of Wave Digital Assets, as well as Chasse, chairman of MV Global and founder of Paid. We're here to discuss the digital asset ecosystem and if the U.S. has the potential to become the crypto capital of the world. It is great to have the both of you with us. Kyle, it's interesting, if you were to have this conversation, let's call it 12 to 18 months ago, thinking of the US as the crypto capital of the world, that would have looked a little bit different. We have certainly catapulted to another stratosphere over the past 6 to 9 months, let's call it.
Yeah, 12 to 18 months ago, I was chilling in my house in Thailand and observing, and Dubai was the crypto capital of the world at the time, but US was nowhere on the radar. I had zero intentions of being back here. And when Trump started campaigning, make America the crypto capital of the world, my ears started perking up. And I said, well, maybe I should go home. Maybe I should go try it out again. And that started as kind of, okay, is he just trying to get votes or is this real? And the more real it became, the more interested I became in coming back home. And I've been back in the States for 2 months now and working with the White House on policy and how we can actually bring our company, which has been very successful overseas, into America and create jobs and create opportunities for Americans.
Yeah, unless it's interesting because it's not even just the regulatory environment starting to get framework around it. The space itself has matured.
Yeah, I mean, look, I think the space is really exciting, but I think that goes hand in hand with, being a regulatory capital in the world. In 23, when MiCA happened in Europe and we started to kind of see innovation leaving the country, there was a real concern, especially on my part. But now it's changed. As Kyle pointed out, the shift with this administration kind of opening up regulatory opportunity, as I like to think about it, not shutting companies down by enforcement, has been an incredible time to innovate.
Yeah, I mean, if you can't understand what your operating guardrails look like, right, we're not going to continue to be the innovative leaders of the world, because how can you introduce new product and new strategies and derivatives off of that? But I think part of it too is it's less of an ethos of us versus them, and the integration and user experience that has certainly improved over the past 12 to 18 months as well.
Yeah, I mean, I think it's totally improved. And, the funny thing is, when we started our company as a registered investment advisor, we didn't have a regulatory path at all. So we had to follow traditional regulatory paths the best we could. That meant being an RIA with California. That meant, moving into being an RIA with the SEC. So we had a path we were following. The sad thing is, the SEC at that time didn't really care. So, I mean, look at the Ripple case, for instance. They went after the biggest, and Coinbase. They went after the biggest companies out there that were doing their best to be good companies in the space.
Yeah. Kyle, are you starting to see others within the space, the brain drain, return back to the U.S., or at least interest to, get back on the side?
A lot of founders that I speak to that are moving back to the United States, and not just smaller ones, large ones too. But what Les said is actually really accurate. Is we've created an entire new asset class, an entire new type of investable asset or tradable asset or hard tokens, tokenization, and we didn't have any type of regulatory clarity before, and it was really hard to understand how we can operate with this thing that doesn't make any sense when all the SEC was doing was using half a century plus year old kind of laws that were invented for things like orange groves versus digital tokenized assets. And so there's been a huge misalignment between people creating crypto assets and what are traditional securities. And so we've been, like Les said, if we only had to go off of what regular traditional regulation was, it just doesn't make any sense. It's completely apples and oranges type of legislation. So right now we're working on, Congress is working on the Clarity Act, and we already had the Genius Act, but Clarity Act is more interesting for me. They're both really important for America, but the Clarity Act is really important for people who are building in this space and founders that want to come back to the States. This is finally going to give founders the clarity that we need in order to understand how we can operate. And you can bet once that passes Congress, we're going to have a flood of entrepreneurs, capital, markets, all coming back to America, the likes the world has never seen before. And that will truly change America to the crypto capital of the world. Why? Because we're the biggest consumer market in the world. We're the strongest economic market in the world. And so it makes sense that we bring one of the biggest innovations the world has ever seen back to America.
Yeah, it's interesting because you can introduce all the product that you want, Les, but until we got this regulatory clarity, that's when you're going to get the scale. I mean, it just opens up the floodgates.
Yeah, and I mean, a good example is, we've obviously had lots of conversations with traditional banks over the years, and, we go from banks debanking companies. Now, they want to know how to get into the space. And, this is the bigger bulge bracket banks and not just boutique banks. And because they realize, as Kyle said, it's another asset class that's emerging. And when traditional finance really kind of kicks in at scale and we start to see exposure from pensions and endowments and insurance companies where they couldn't do direct exposure, to cryptocurrencies, then we're really going to see it explode.
Yeah, and I also think, Les, we tend to think of this through a very US-centric Western lens where we have traditional banking structure in place. We have access to banks. We have access to capital. I mean, we're the number one capital markets, capital formation spot in the world. But the fact of the matter is there's billions of people around the world that use the underlying technology and infrastructure to build micro-local economies, get other forms of capital formation, trade cross-border, and we have to think about it in those terms as well, which is why the Genius Act and stablecoin framework is exciting, because now ex-US investors have access to our treasury market, to our public and private companies. It just brings money back here.
Yeah, that's a really important point. There's a lot of confusion, I think, around the stablecoin bill and, how's it going to hurt the dollar? And it's actually going to improve the dollar. When we, have stable coins, they're buying treasuries ultimately outside of this country, it strengthens the dollar. So, it's an exciting time for everything that's going to bring.
And stablecoins are supporting the US dollar and US government debt. Now 1% of all US M2 is held in treasuries by stablecoin issuers between Circle and Tether. So that is really important for us to be able to continue to do what the US is doing, raising the debt ceiling, continuing to it has no other choice. But this was a way that conveniently came in. This is why you see the Trump administration and Congress pushing aggressively the stablecoin bill, the Genius Act, through Congress, because it's a lifeboat essentially. It's really enables, and also enables the dollar to be spread across different countries and easier for demand for the dollar as well.
Yeah, I mean, there was that big narrative of de-dollarization over the past couple of years as well. So this certainly does help to mitigate some of that. Speaking of risk, I mean, we have to acknowledge some of the risk and the challenges associated with a younger asset class. I mean, it's not as old as equities, as bonds. They've had, multiple decades to mature and so forth. So, I mean, there are going to be challenges along the way. We'd be naive to think there wouldn't.
Yeah, I think that's really important that we bring that up. One of the things that the SEC has been pretty clear on is that we need disclosures. And I 100% agree. As someone who has traditionally grown up, I wouldn't say that I've been an anarchist, but I've been someone who wants to see innovation happening. I want to see, I want to see democratization amongst retail. I want to see access for the 99% to the traditional kind of investment opportunities that historically have been reserved for the 1% for Wall Street. But one of the things that I've observed in our industry, when I say our industry, I mean the crypto markets, not necessarily bringing TradFi on chain, but real what you're talking about. What are these opportunities emerging that really the audience hasn't really even seen yet, because most of it is bringing TradFi on chain. But disclosures are going to be really important, because for the first time ever, you have companies that start and they're really raising capital and issuing and creating value in two different buckets. One of them is an equity bucket. The other one is this token bucket. And that's very confusing and oftentimes misleading for retail investors or investors to understand, okay, you as a team, you're creating value, you're building this product, and the value that you create, is that being distributed to the equity side of the business or the token side of the business? And right now there's no disclosures, right? And so that's a really big deal. So I'm advocating, I really want clarity. I want regulation. I want our industry to mature so that we actually can level up our game and be taken seriously.
It's really interesting, when Kyle talks about disclosures, I immediately go to the other side of the business, which is kind of regulatory enforcement and how they follow kind of the trails of tokens and what happens with them. And track and trace companies like Chainalysis have been out there for a long time, and qualified custodians have been around for a really long time. And what we're seeing, because of its administration, is the states, which are kind of ground zero on a lot of this activity, a lot of the building of new companies, start to adhere to or try to get a deeper understanding of how these tokens work. And the thing about a new asset class that's complicated is, when we go back to the stable coins, these assets can generate yield in a way no other assets have ever generated yield. So we can actually see shared yield to the consumer from the hybrid of traditional financial instruments blended with these tokens, as underlying.
Yeah. Well, I mean, it goes back to the point that you made before that the Consumer Protection Acts are perhaps antiquated because they're not looking at products that are relevant today. Even if you look at traditional alternative investment products and so forth that retail investors have exposure to, truly understanding the underlying and the liquidity profiles and so forth, we're starting to see tokenization of assets. There was the announcement this morning where you're going to be able to access, or invest into SpaceX via a token, right? So what does that look like? Is the underlying owned? What's the liquidity profile? What happens if my investment goes down? How do I get in and out of this? That inherently is consumer protection. They have to update it.
Yeah, this morning I was just on a call with the White House with Bo Hines' team, which is the Presidential Working Group for Digital Assets. And one of the things, why I moved back to America was to bring my company Paid Network back to America and to be able to offer these type of products that you just mentioned to Americans. And it's been completely prohibitive thus far. I know that if we would have done this during the previous administration's time, we would have been slapped with a Wells notice or just a cease and desist, something like that. And now we're kind of saying, well, can we do this? And that was the call that I had this morning. But we want to offer, early stage investment opportunities to retail and make sure that we have proper disclosures, proper risk management. But that's something that also, historically, any access to private markets has been essentially prohibited if you weren't an accredited investor. Well, how are the 99% supposed to up their game? How are they supposed to become a different type of wealth class if they're not allowed to participate in the things that generate the most wealth? This is completely absurd to me, And so one of the things I'm really passionate about is trying to bring access to Americans an opportunity they've never had before. When you're buying an asset, which they're allowed to do through Robinhood or otherwise on the secondary market, this is after the valuation's already multiple billions of dollars. Let them get in and let them take, you can go to Vegas on a Friday night with your friends and blow your entire bank, right? But you can't participate in an educated, guess on whether this next robotics company or nuclear company or AI company, with all this stuff that's happened from Trump recently with the executive orders to, deregulate nuclear, supersonic travel, AI, like these are really exciting industries that have been really red taped and restricted before. Now, these investment opportunities are everywhere. Capital's coming in, new companies are starting up. We're seeing growth in other sectors too, other than crypto, and I think those are really interesting. So let's tokenize those opportunities earlier, let 99% in on them, and give them an opportunity to take advantage of the upside.
You make me think of a situation, my 14-year-old nephew, I taught him about crypto. He made about 70 grand in crypto when he was 14. And you think about the accredited investors out there and how they qualify. I'll tell you this, a lot of the accredited investors I know don't know anything about digital assets. Yeah. So when you were talking earlier about native, look, they grow up with computers, they grow up understanding these assets inherently. So.
Well, it's funny when you hear another anecdote. When I first got into this business, later 90s, and I remember putting together pitch books, the big spiral ones, this thick, of just one fund that was an alternative investment for an accredited investor. To your point, I can 99% guarantee will not have the same understanding of digital assets as it exists today compared to those, 500-page pitch books for just one fund. So, you can even correlate it to, look at the platforms that are available for retail investors just in equity and options today that did not exist on the institutional desk when I first got into the business. We're just trading paper and fractions back then. So this could perhaps be, the next iteration of that. I mean, you've seen the digital platforms, Schwab, any one of those. Tools are amazing.
I think the interesting thing is the technology allows new innovations like we haven't seen before. So when you're talking about investing into early stage companies, normally if you're investing into equity, you'd have to wait all the way until some sort of exit or an IPO, and that could take 10 years, right? And that time horizon is just, it's long compared to what we've seen in the crypto markets before. But now that you have blockchain technology and all this stuff can settle on chain instantly, one of the things that we're building is a way that you can have liquidity on your primary market investments by creating a secondary market, essentially, where people can buy and sell based on what they believe the future prices of this thing before it gets to a liquidity event. And this is happening, like you said, from Robinhood and what Larry Fink and Citadel want to do on the Texas Stock Exchange. I'm speculating here, but the Larry Fink's push for the SEC to allow this tokenized equities trading is a pretty clear signal.
You know, going back to Bo Hines, you made me think about something. You know, the one thing this president has done is surrounded himself with a lot of guys that are native to crypto. You know, Bo was talking about crypto and overregulation, you know, with the SEC long before he ever made it to this administration. This president has surrounded himself with a lot of youthful folks that know the market.
Yeah.
And, you know, the big problem with kind of what's happened in the past is you can't keep up with it. You know, I do this every day, and you know, Jill, how fast this is. And to surround yourself with like these younger guys that understand it, that's how they're keeping up.
Yes.
I think on a broader perspective as well, because we've had a number of the younger crop of Congress folks come on the show as well. And it might not necessarily be in crypto, but financial services, defense tech, and so forth. They're also of the mindset of privacy, security by design first. And I find that highly encouraging that that is part of the development and product introduction process, where it's not like, okay, let's just be innovative for the sake of being innovating, but what are the problems and how do we design this with cyber and privacy first? And I find that encouraging.
I find it all encouraging. I find it encouraging for DeFi. I find it encouraging, you know, for all of the new innovative products that are going to be coming.
Because sometimes the pushback is you're going to see illegal activity with this newer technology and so forth. Well, guess what? We didn't stop trading equities after Madoff. There have been a number of wire and cash scams that have existed, and whether it's digital assets or another type of asset class, it's human nature. People will find ways to exploit it. So the guardrails that are in place, and if we think privacy by design first, that helps to mitigate it at the jump. So.
Well, look, the other thing that's really great about that is now we see the integration of AI into cybersecurity, into crypto. So when we start to take all these kind of underlying hybrid technologies, and you know what's going to be developed is going to be incredible, and I think it's going to be really difficult for criminals to kind of keep up with that, even just the speed that the development's happening.
Yeah, especially when you're thinking about democratization and accessibility, as you had mentioned before, Kyle, the transparency and the accountability that these newer technologies layer on top of the digital asset infrastructure lends to that as well. And I think, folks such as yourself that have been advocating with the administration and working together, again, public-private partnerships and academia are how we advance these policies forward. I think it's great work on the industry's part.
Yeah, I think that, one of the things too that we were looking at before, I covered them extensively on my YouTube channel, was, we were looking at a lot of trials for central bank digital currencies. And one of the things that Trump came out with right away on his executive order was to ban retail central bank digital currencies. And I think that's really interesting. Talking about privacy, that would be the antithesis of privacy, right? And blockchain, because of its cryptographic nature and because of the things that we're developing, inherently will provide user privacy when user privacy is needed, with caveats that maybe there's some way that can be done if there was a federal subpoena or something. But for me, it was a huge relief to see that we were going away from central bank digital currencies, as I think that those would be pretty dystopian in the way we're headed. So we got stablecoins instead, which was a welcome. And some people with a tinfoil hat might call those central bank digital currencies, but they are far different from them.
I would agree with you. I know something from a national security perspective, it was a smart decision to be made that stablecoins in a more centralized fashion were the way that the administration decided to go, right? Because anyone in theory, right, could create their own central bank digital coin, right? So China could do it, North Korea could do it, Iran, Russia could do it.
China has done it.
Right.
So, well, yeah, with the digital yuan.
So thinking about this through the lens that you had just explained it, I think it also puts national security at the forefront as well.
Look at the shift as well. I mean, remember when Libra, and Facebook, they stopped it then because that was going to be a world currency theoretically.
Well, the problem with Zuck was that he was trying to be too smart, and he tried to make Libra a basket of different fiat currencies from around the world to create a little bit more stability, because he had seen that maybe the US dollar wasn't the most stable, and we see now that it's lost, what was it, 2% purchasing power in the past month alone, something like that. Now we have the debt ceiling rising, potentially with the big beautiful bill, $5 trillion, which that's going to create more future debasement of the dollar. But if Zuckerberg had just done Libra with the only reserve currency being in that basket would have been US dollars, they probably would have been approved. But the fact that they were trying to do it. So that was $1 billion of R&D that got wiped out.
But that's how we learn. It's part of science, right?
A lot of great companies came out of that.
Yeah.
SWE and Aptos came right out of that. So.
All right, well, forward thinking. We'll leave it at that. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.